Imagine a natural disaster, a hurricane, a flood, thousands of cars underwater. For most, it's a tragedy. For insurance companies, a logistical nightmare. But for one company, it's a chance to show why it rules a multi-billion-dollar market. That company is Copart, ticker CPRT. It doesn't make cars, doesn't sell insurance, and doesn't run repair shops. Yet, it's a key and very profitable part of the global car world. In this video, we're going to take a close look at Copart's business model. We'll find out why it has one of the strongest economic moats out there, how it turns wrecked cars into a steady stream of cash, and why, even though it's a giant, many investors still don't know about it. If you want to understand high-quality companies with lasting competitive edges, stick with me. This is the deep dive into Copart. What does Copart really do? To understand Copart, forget the image of a traditional junkyard. Think of it as a tech and logistics platform with something priceless: land. Started in 1982, Copart created and now leads the market for online auctions of salvage vehicles. But what is a salvage vehicle? A car gets into an accident or is damaged by a flood. The insurance company checks how much it would cost to fix. If it's too high, let's say more than 75% of the car's value, they declare it a total loss. The insurance company pays the customer and keeps the damaged car, and that's where Copart comes in. The insurance company doesn't have the know-how, the space, or the desire to store and resell thousands of these cars. They hand over 100% of this process to Copart. Copart then tows the vehicle to one of its giant lots, handles all the paperwork for the car's title, and puts it on its global online auction platform, a system it pioneered to be 100% digital back in 2003, long before its main competitor. And who buys these cars? A huge network with over 1 million registered members worldwide. Junkyards, mechanics, rebuilders, exporters, and even regular people. They buy the cars to sell the parts, fix them, or send them to growing markets. Copart makes money by charging fees to both sellers, insurance companies, and buyers. It's a platform business model with high profit margins and a strong network effect. The nearly unbeatable economic moat. Okay, the business model is interesting, but what stops another company from doing the same thing? This is where the investment idea for Copart gets really strong. Its economic moat stands on 3 solid pillars. First, the mix of land and relationships. Copart owns about 90% of its more than 9,500 acres of land. Its main competitor, IAA, now part of RB Global, rents 90% of its land. Why is this a huge advantage? Predictable costs. Copart isn't subject to rent increases or a landlord deciding to use the land for something more profitable. Trust for insurers. Insurance companies see Copart owning land as a long-term commitment in a certain area. Barrier to entry. Try to find and buy thousands of acres of land near cities with the right zoning to be a vehicle yard. It's a logistical and money nightmare. This big physical presence allows Copart to offer excellent service, especially during disasters. The case of Hurricane Harvey in 2017 is a great example. Copart took care of over 90,000 damaged vehicles. They rented temporary land and hired fleets of tow trucks, losing money in the short term. The result? A big American insurance company was so impressed that they moved some of their business from competitor IAA to Copart. They traded a short-term loss for long-term market share gains. Second, the network effect. It's a good cycle. Insurance companies want the highest possible price for their salvage vehicles. They send their cars where the buyers are. Copart has the biggest network, with over 1 million buyers worldwide. More buyers mean more bids, which drives up selling prices. Higher prices make insurance companies want to use Copart even more, which brings even more vehicles to the platform. More vehicles attract even more buyers, who like the variety and volume. This cycle keeps getting stronger and makes it very hard for a new company to compete. You can't attract sellers without buyers, and you can't attract buyers without a lot of vehicles. A financial fortress. Such a big moat needs to be supported by a strong balance sheet, and Copart's is a great example. Zero debt. At the end of fiscal year 2025, the company had almost no debt. It paid off its last bonds in 2022. Strong cash. The company has billions of dollars in cash and investments. In July 2025, this amount was $4.8 billion. Consistent cash flow. Since going public in 1994, Copart has generated positive operating cash flow every single year. It's a strong business that doesn't rely on economic ups and downs. This financial strength is no accident. It's a smart tool. It lets Copart invest a lot in growing its land and technology without needing outside money. It lets them act fast to buy land in good spots when chances come up. And it gives them the ability to pay for disaster costs, as we saw with Hurricane Harvey, to make their market position stronger. The future growth engines. A leading company in an old market might seem to have little room to grow, but Copart has two very clear ways to grow. The main growth driver in the United States is the increase in total loss frequency. And why is this happening? Modern cars are like computers on wheels. A bumper today has parking sensors, cameras, radar. A small bump that used to cost little to fix today might need expensive electronic systems to be replaced and recalibrated. With labor and parts costs going up and cars getting more and more complex, the point where the insurance company decides it's not worth fixing, the total loss point, comes faster and faster. This is a long-term trend that directly helps Copart, increasing the number of vehicles that come onto its platform. The second big boost is international growth, especially in Europe. The European car market is huge, but the claims process is different and more spread out. In many countries like Germany, Copart still works in a way where it buys the cars and takes the risk of reselling them. Copart's big goal is to change these markets to its consignment model, which makes much more money and can grow faster. It's a slow process, which means changing how local insurance companies think and dealing with different laws in each country. However, the potential is huge. Any progress here could lead to double-digit growth for many years. Bulls versus bears. Risk analysis. The bulls say, Copart's moat is unbreakable based on physical assets, land, and a strong network effect. Its financial health is perfect. The trend of more total loss frequency is a big boost, and the strong balance sheet allows for stock buybacks and smart purchases that can further increase shareholder returns. The bears say, what if the competition wakes up? IAA, now under RB Global, could become a much better operator and start fighting for market share. Growth in Europe might be much slower and more expensive than the market expects, due to the complicated laws in each country. And finally, what will the company do with so much cash? If this money isn't used wisely, it could end up lowering returns. My opinion, these are good points. The risk from IAA's competition is the main thing to watch. However, Copart's built-in advantages, especially owning land, are hard to copy. International growth is indeed a long-term gamble with uncertain results. As for the cash, management has an excellent track record of putting money back into the business with high returns. Their main goal has always been to strengthen the moat, not to pay dividends, a way of thinking that has served long-term shareholders very well. Leadership and capital allocation. Finally, let's talk about who's in charge. Copart's culture is a direct reflection of its founder, Willis Johnson, and a management team that focuses intensely on the long term. Their idea is simple: invest a lot back into the business to make their land capacity bigger, improve technology, and make services better for insurance companies. Over the last 10 years, they've spent about 15% of sales on capital expenses, and even with that, their returns on invested money have stayed consistently above 20%, even reaching over 30% at times. They don't buy back shares often, preferring to save cash for chances to buy land or companies that will make their main business stronger. They value being flexible. For Copart's management, a perfect balance sheet and the ability to invest when others can't is, in itself, a competitive advantage. This is management that thinks in decades, not in quarters. Conclusion. So, what do we have in the end? Copart is a great example of a very high-quality company. It works in a smart two-company market, has a deep and lasting economic moat, supported by physical assets and a strong network effect. Its balance sheet is very strong, and its management has a proven history of smart money decisions with a focus on the long term. It benefits from long-term trends, like cars getting more complex, and has a chance to grow through expanding internationally. Risks exist, mainly competition and challenges in Europe, but Copart's competitive advantages seem strong enough to handle them. It's one of those companies that works behind the scenes, away from the bright lights of consumer tech, but that runs its business with great accuracy, creating steady value for its shareholders over time. I want to know what you think. Did you already know about Copart? What do you think of its economic moat? Leave your comment below, let's talk about it. If you like this analysis, don't forget to hit the like button, subscribe to the channel, and turn on notifications so you don't miss the next videos. Thanks for watching and happy investing.